Hi everyone, thank you for joining so far. I can still see there are a few more sort of people joining currently, so I might give it another 30 seconds or so. But in the interest of time, we'll look to start relatively promptly. So we'll just give it a few more seconds, then we'll get underway. I think that's right. Yeah. Okay. Well, I think as I mentioned, in the interest of time, we'll get started. So, thank you again, everyone, for joining us today. Again, it's always good to see some familiar names and also some new people onto the call. Those of you who haven't joined us before, this is our quarterly sort of market insight update webinar, where we will give you an investment summary on previous quarter we just had, and our views and thoughts, and also our outlook as we move into 2023. As you can also see, this webinar will also be joined by Alistair, who's going to talk to us about the VCT season, which is just started and starting. So the call will be split into the first half. Mo will be talking to you, and then the second half will be Alistair. So, as always, at the end of the call, we'll have a Q&A on both the investment market side and also the VCT stuff. So, if you have any questions, as always, send them in, and we'll happily answer them at the end of the call. So, without further ado, I'll let Mo, you get underway.
Brilliant. Good afternoon. Thank you very much for joining us today. As Tommy mentioned, we're going to do a quick Q3 recap. As you may have seen, for those of you who've joined us before, the themes that will be discussed are quite similar to what we've talked about previously, largely because they have driven markets throughout this year so far. If we start, I think, with this particular slide. Now, we look at the last 12 months and this chart here. So this represents, the black line is the MSCI World. So that's the index that covers most equities around the developed world. And the red line is the Bloomberg Global Aggregate, which is effectively the MSCI World of the bond market. So it encapsulates most of the bonds globally. And both of them are very represent each of those asset classes across the world. Now, as you can see, over the past 12 months, it has been an exceptionally difficult backdrop. And the reason why I mentioned these two particular asset classes is because they form the building blocks of most portfolios and have done for the last sort of 35 years or so. And they typically moved inversely to each other. So you'd have, when equities were coming under pressure, bonds would do quite well, and vice versa. So this year clearly has been very, very different. And as a sort of bond holder, you probably have done worse than as an equity holder. And then in the context of portfolios, so that therefore implies that if you're a high-risk equity investor, you've probably done as poorly as somebody who is a low-risk, typically bond investor. So look, exceptionally difficult backdrop. Doesn't fully apply to us because whilst they are the core building blocks of what we do as well, we do try to invest elsewhere, but it has been an exceptionally difficult backdrop to navigate through. If we just do a quick recap of Q3, what we saw at the beginning through July and into the middle of August was a very strong move up in markets, equities in particular. We saw the S&P 500, for example, the main US stock market, rally strongly. But unfortunately, what happened in the middle of August was the central bank over in the US, the US Federal Reserve, made some statements which effectively poured cold water on the optimism. And we subsequently saw quite a sharp move downwards in markets right through September. giving up all of the gains that we've made earlier in the quarter, and they actually ended up lower than where they started. Bonds followed suit; they were no better. They effectively followed the equity market as was evident in the previous chart. And what we did notice this time was that the correction was slightly more widespread. So it wasn't so focused in the particular sectors that we came under pressure earlier in the year, such as the technology sector. This sort of caught quite a few more assets and asset classes as the quarter progressed. Clearly, I hope many of you have read our quarterly market commentary. UK fiscal policy and the budget announcement recently was unhelpful. It led to a lot of market volatility, and not only in the UK, but it actually did ripple through to other parts of the markets around the world, and was generally seen as sort of a negative event. So clearly unhelpful and simply adding fuel to the fire that we're already seeing. This is something that I've mentioned in the past, that the markets continue to be dominated by some key macroeconomic themes, the main one being central bank policy to the inflation levels that we've seen over the last sort of year or so, and more recently concerns around the potential for a recession building. Again, as a result, the central banks, i.e. US Federal Reserve, the Bank of England, have remained hawkish, i.e. they have continued to pursue higher interest rates. And I'll come on to that a bit more because I've made some more comments on that later on. And again, something that I've mentioned previously is around recession concerns, which are more demand-led as a result of very restrictive central bank policy. And just in terms of some statistics, so over the quarter, the portfolios were generally down between 1% and 3%. That's sort of a core range of portfolios, after being up by quite a lot. So it was quite disappointing in the end. Right. So if on the inflation front, we are seeing some signs of year-on-year inflation, i.e. as measured by CPI, coming down very slightly. So it's nothing material yet. In the US, I believe that's come down to 8.3% year-on-year. And in the UK, it's about 9.9%. However, when we look at the core components of inflation, i.e. sort of wage pressures, they have not shown any signs of easing just yet. We continue to have supply chain problems around the world, and just as a reminder, that is really what led to this recent round of inflation, which was the supply chain problems coming out of the pandemic. So those issues have not been resolved yet. That's largely, well, in part because of China's zero COVID policy, which has been very restrictive on their economy, and therefore, because they are continue to be a global manufacturing hub, that then has knock-on effects around the world. So we're still not seeing smooth supply chains, and therefore that is continued to keep upward pressure on the cost of goods and services. Energy prices also remain elevated, although they are lower than they were a couple of months ago. But both of these things are continuing to keep upward pressure on inflation. As I mentioned, as a result, central banks have remained hawkish. It's worth mentioning here, I think, that certainly with regards to US Federal Reserve, and I'll come on to this a bit later on, but the current interest rate in America is between 3 to 3.25%. They've suggested that there's this end goal, or the point at which they may look to pause, is around 4 to 4.5%. Most economists around the world are suggesting somewhere between 4.5 to 4.8%. Given the way that they've been hiking, that would imply that we're probably 2 or 3 interest rate hikes away from a pause. And we would view a pause as something that would be actually a positive market, because the interest rate rises have kept a lid on all asset classes and markets so far. And so any easing of that pressure should lead to some recovery in the market. So it's, of course, it's very difficult to say when that's going to happen, but assuming it's 2 to 3 interest rate hikes, it could be not very far away. I've already talked about the US Federal Reserve. The Bank of England obviously on a similar path, but given the budget announcement, they are now pressured to raise interest rates significantly higher than where they are now, with broad expectations being somewhere between 5 and 6% next year. Clearly, from a UK perspective, that's quite a material move, and it's likely to have a material impact on the economy here. I've mentioned this before, and I think what's been interesting is that they haven't developed as quickly as some expected. There were some lots of news articles and various sort of thought pieces going around back in June time about the risks of the rising risk of a recession coming through. Unsurprisingly, given the very restrictive monetary policy that we're seeing. However, that hasn't really come through as quickly as people expected, certainly in the US, where I would say the data is quite mixed, where some data is actually hanging in there. Other data points are slowly starting to come off a little bit. And again, this is really demand-led issues such as the cost of living, and particularly the input costs and refinancing for businesses is just becoming more difficult. That means is what we expect to see is ongoing market volatility. There's still a lot of uncertainty around, so we continue to expect markets to be volatile. However, because the corporate landscape is going to be more challenged in this environment, those companies that are not in a strong position are obviously going to come under more pressure than those who are of a higher quality, have higher gross margins, are more profitable. So we are actually starting to see signs of that very, very, very recently. And we have been very mindful of that in the portfolios because we have maintained a high quality approach, and as the years progressed, we have gravitated more so to those sorts of companies because they are likely to weather this environment better. And quite often what's the case is strong companies in difficult markets tend to take market share and come out even stronger. So with regards to our actions over the past quarter, I mean, they've really just echoed what we've done across the year, which is to focus on lowering the volatility levels in the portfolios. We believe that what we've done has worked very well. Clearly, it's with that backdrop that I showed at the beginning, it's difficult to see a material impact. This is more sort of marginal improvements. But as we progress into the end of the year into next year, we expect those benefits to come through more strongly. So I think we are very happy with what we have at the moment. The volatility levels have definitely come down, and we will continue to assess what's going on in markets to ensure that we can navigate through this volatile period best we can. In terms of the strategy moving forward, so again, I hope you've read our quarterly note, which just went into a lot of detail on this. But the key being that we will remain invested fully, but maintain a lower volatility approach. And the key thing here is that I think quite often when a positive bit of news comes through, especially the important parts, such as the US Federal Reserve, for example, when it does come through, it might not necessarily be obvious, and therefore, the subsequent market response tends to be very, very quick. We've seen this in the past, and so holding anything such as cash can actually be quite dangerous when the turn comes. And so we've tried to ensure that we've remained invested, but as I mentioned, the lower volatility approach. Again, referencing my initial chart, the correlation between asset classes has risen significantly, almost across the board. And you know, I only referenced the MSCI World and the global bond market, but I mean, you could add in several other asset classes such as gold, some of the Asian markets, and others. I mean, they've all behaved in a similar way. So having said that, you know, the yields on some areas of the bond markets are becoming quite attractive. And so we have been sort of leaning into some of those bond markets, and we will continue to monitor those. I think we want to just be slightly careful about how we approach that. But some of the yields on offer are starting to become very attractive, and could offer a reasonable entry point whenever the markets finally look back on this difficult period and move forwards. We will continue to maintain our largest equity exposure to the US, given that the US Federal Reserve is much more advanced in their hiking cycle than other parts of the markets. And I think they're maybe less, slightly more insulated from the energy issues that we're seeing, certainly in Europe and the UK. We will maintain our largest exposure there. They are likely to come out of this tough patch before anyone else. Something I talked about in the quarterly note again were the potential positive catalysts that we saw on the horizon. Some of them maybe sooner, others more distant. Clearly, the end of the Ukraine war would alleviate pressure significantly on markets, particularly around commodity and energy prices. Clearly, it looks very unlikely for that to happen anytime soon, but nonetheless would be a strong positive catalyst. Maybe closer in terms of timescales, as I mentioned earlier, is a potential pause in the interest rate rises in the US. That actually seems like it could happen either at the end of this year or early next year, and there is now an increasing amount of talk amongst the investment community about not if but when. It's very likely to happen. We are waiting patiently. It's clearly created a lot of problems this year in markets, but we expect that when the pause comes, that will alleviate a lot of pressures on the markets, and we should begin to see a recovery. So eagerly awaiting for that. The other one that's perhaps less talked about is easing of China's COVID restrictions. So as I mentioned earlier, they've got their zero COVID policy. However, I think there's two things going on there. One, they are moving towards easing restrictions. And the second thing is that they have been developing their own mRNA COVID vaccine. So clearly we have something, we've had something like that for a couple of years now in the Western world, but they do not have one in China yet because they wanted to have their own one. So having spoken to some fund managers and some people in the industry, we understand that they have made very good progress. One company in particular has had very good trials. And so whenever they come out with their COVID vaccine, which as we saw in here, it came out pretty quickly, that again, you know, could help to ease their COVID restrictions and in turn, by the way, ease global market pressures, because as I mentioned earlier, a lot of the supply chains around the world have China involved. And so easing those restrictions will then ease supply chain problems, and which in turn could ease inflationary issues from the supply side. And so there's quite a knock-on effect it could have. So again, eagerly monitoring that, not as widely spoken about as the potential for the US Federal Reserve to pause interest rate rises. So just in quick, brief summary, markets are going to continue to be driven by central bank action. That has so far been very negative, of course, but it may well become actually positive in the next sort of couple of quarters. As I mentioned, the focus continues to look at move towards recession concerns. and there's a lot of sort of data watching going on that front. One thing that we do think is a possibility is that in the very short term, we could see some of the inflation pressures beginning to ease for reasons that I mentioned before. But that is a short-term view. We think that longer term, we are very likely now to be in an environment of structurally higher inflation, and we certainly don't believe it's going back to the sort of 2% or below 2% era that we've seen over the last sort of 12 to 14 years. As a result, with structurally higher inflation, markets are likely to remain volatile. And as mentioned, the key being really that we have been focused on lowering volatility levels and ensuring that we have a very high degree of quality in the portfolios, because those are the sorts of companies that are best positioned to weather become a difficult environment for the corporate landscape. Right, I think that's enough for me. That brings me on to our discussion on VCTs, and Alistair here has just joined, and he'll go through the current season.
Thank you, Mo. Thank you, Tommy. I wonder if you could put Tommy the first slide up on the VCT presentation. While that comes up, tax benefits. The first line there suggesting as an investor you get an income tax relief of up to 30%, and that's 30% on your taxed income, whether it be PAYE, whether it be rental income, anything where you pay income tax, you are entitled to 30% of whatever you put into a VCT each year back from the government. So I think it's worth going back through the history of the development of VCTs and why the government, the Treasury, it seems to be keen to give you money back for making investments. Venture capital trusts and EIS schemes are government-backed, long-term investment schemes, and they're listed on the London Stock Exchange. They report twice a year, so they're very, very transparent for investors. They've actually been around since 1995, and the reason why it was set up is still the same as today. They're intended for investors to help to invest and support early stage companies and businesses based in the UK, where entrepreneurs need capital at a time where other sources of finance are not yet available. So this is pre-IPO, pre-public offering. These are all the various stages of raising money, seed through to venture capital, Series A, Series B, but these are private companies. There are a number of VCT rules, and they state that investor tax benefits are available as long as these companies are young. And by young, that's less than 7 years old. And there are rules around exactly what type of companies can be invested in. Therefore, they can be risky. There is no guarantee the companies will be a success, and some will fail. So to compensate investors for taking this equity risk in early stage companies, the Treasury is happy to offer investors these tax breaks, and they're listed here. So as well as the income tax relief, you have tax-free dividends and tax-free capital gains. And a number of these VCTs pay dividends now at least twice a year. One in particular, Albion, pays every month. So they can work as a very good alternative source of income, tax-free. You don't have to include any of these details on your tax return. The downside is you can only do £200,000 per person per year, but the minimum is around about £5,000 or £6,000. That's generally the amount that the VCT companies set as a minimum. But most importantly, the reason why these are more risky than public companies is that you must hold these VCTs for at least 5 years. So they're long-term, high-growth company investments, and you can't get your money back for 5 years. You can, but you then lose all the tax benefits that you've received over that period. So this is for money that you're happy to put away for at least 5 years. And what we've seen over the last 10 years is that actually people begin to get quite attached to the dividend flows. They are 5 or 6% per year. They're tax-free, and actually they become long-term investments beyond the 5 years because of that feature. Next slide, please, Tommy. So just a bit on the market evolution. There are over 12 VCT companies in the UK. I think we probably spend our time doing due diligence and research on those 12. There are others, but there's 12 in particular that we take a look at. And last year they raised just over £1 billion. A VCT company will invest on average into around 60 to 70 investments. And that's the major difference between VCTs and EIS. So EIS are generally schemes intended for one company investments. And as a result, being just one company, they can be more risky than a collective of different investments. Up to 60 to 70, you'll have some very good returns on a few of them. You'll have some okay returns on the majority, and there will be some failures. But at least you've got that that portfolio effect, which does reduce the potential for losses. And as I mentioned earlier, and going onto the shift to growth companies, which is the first point on the page, historically VCT companies first invested in renewable energy and management buyouts, which were seen as relatively low risk for very, very different reasons. When the Treasury deemed that investors were not taking enough risk, they had government contracts that were backing some of the renewable energy investments. Management buyouts, you're really backing a mature company where the owner is looking to sell. So again, not creating employment, not investing in R&D, research and development. And the Treasury said, no, you can't do that anymore. But they've got some very grown-up rules, and they didn't say you have to sell those investments. They just said you can't add to them. So even today, there are a number of VCTs where you will be buying into, when they raise money, you'll be already buying into mature investments like renewable energy and management buyout companies. Even though 15 years ago they were allowed, and they're not now, you still can get exposure to them. That's one of the great benefits of VCTs. So as I said, they were deemed to be of low risk, and so the rules now state that you must invest in growth companies. That's companies that are less than 7 years old, and for a number of reasons, these growth companies are involved in many new exciting industries, and it looks very attractive: digital health, cyber security, fintech, and software and data services. So they're the main holdings that have been and investments that have been made over the last 5 years since the rules changed. And we've seen obviously an explosion in the number of companies that are in those industries. We've seen a lot of change going on as these companies are becoming more mature and taking on incumbents. So they have been very exciting investments to make. And in terms of data, the Venture Capital Trust Association reckons that since 2018, there's been over 1,000 investments in over 500 companies, totaling 1.7 billion, of which over 50% were follow-on investments into existing VCT investments. So you're not just doing it on day one, you're going in, and if cash flow becomes difficult and they've not matured yet, VCT companies often, over 50% of the time, will go back in and do further rounds of financing. And overall, the scheme supports over 14,000 jobs that have been created. So this is very much seen by Treasury government as an important way to raise money. And in fact, at the latest mini budget that the government announced a few weeks ago, the industry was given a major boost as the scheme was extended. It started in 95. They were looking to perhaps review it at around 2025, and they've now said, no, that's no longer applicable. These investments can still be made into the future. So that's raised a cloud that was hanging over the industry. A bit about performance. And I'm not going to include the initial tax relief of 30% in these numbers, but long-term returns have been very strong. 5 and 10-year returns have been around 9% per year, and you're receiving those in a tax-free environment. So they're very attractive. This year to date, like other markets that Mo pointed out earlier, we've seen some slight falls in the valuation. We've still seen the same dividends being paid out. We've still seen some investments being sold, but definitely the valuations have reflected some of the falls we've seen in the bond and equity markets. So I would say on average, the VCTs that we look at are down between 0 and 10%, so on average around 5% year to date. And what's really helped that performance is actually that the VCT companies that we've invested in are still sitting on quite a lot of cash that they raised last year. Around 25% of the total assets that they manage is in cash. And they keep cash for a number of reasons. One, to make future investments. Secondly, to do follow-on investments in companies that they like, that still haven't matured and still need cash flow. And thirdly, the VCTs are the only natural place where if you wanted to sell them after 5 years, they're the natural buyer. So you will see every year these VCT providers actually buying back the VCTs in the market from investors. So that's the reason why they always have a rather large amount of cash. In terms of fundraising this year, we're expecting, after £1 billion was raised last year, we expect the number of offerings to be a large number of people coming back to the market, but perhaps less than £1 billion being raised this year, which I think probably is in line with the amount of cash raised last year was a lot higher than the previous couple of years. And just there is a little bit more risk in the environment and in the investment environment, as again, Mo pointed out earlier. So yes, so current VCT opportunities. VCTs tend to raise money between October and March each year. So it's really starting now. And we're happy to recommend 3 VCTs at the moment. Mobius being the first one. They manage around £400 million and they're looking to raise £75 million, and they start to take orders from next Monday. So Monday the 17th is when we can start to make investments into Mobius for this year. And it's interesting to note that they raised money in January this year on a smaller number. I think they were only looking to raise 35 million then, but the actual issuance was taken up within 2 days. So Mobius have got perhaps the best long-term results, but the other 2 that we're recommending aren't too far away. So Albion Capital, they manage around £600 million. We've recommended investing in Albion now for probably the last 7 or 8 years. And they're looking to raise another £50 million, and that'll be late October, early November. And then the last of the 3 British smaller companies, they manage 140 million and they're looking to raise a further 55 million this year. So quite a big raise. Might be worth just saying very briefly here why we'd recommend these 3. First of all, long-term track record of over 10 years. They're, as I mentioned, on average around 9% over 5 years per year, and over 10 years around the same number of 9%. Again, all tax-free. And importantly, the managers and the teams that support the managers have been in place for very many years, and there's very little turnover in the management of these VCTs at those 3 companies, which is really good to see. Second reason is that the majority of the investments that the managers make are into companies that are offering business-to-business solutions and products. And I think we still will probably prefer that to companies that are providing businesses, services to the consumer. There has been some terrific exits this year. M&M, a clothing company, online clothing company, that was a very, very good business to consumer company that was sold. But the majority of businesses that we've seen that consistently get the right investment and the right exit are the business to business. People like Albion sell to companies like Oracle, to Siemens, and that's data software and processing, which these two large companies see as being important to improving their own businesses. And that really is the last point, is just exit successes. These three companies have all had a very successful track record of exiting, and that's really, really important to us. We don't want to see investments just sitting on balance sheets, not really moving. You've got to keep seeing exits, because a lot of the dividends that we receive come from those exits. So that's the sort of three main reasons why these three stand out. As we approach November, December, I'm sure we'll see 2, 3, 4 more VCT managers coming to market, and we'll have a look at what they're offering at that time. But certainly for now, for the next 2 months, these will be the three that we'd be recommending. So that's it. Thank you for your time on that. Mo and Tommy, I pass back to you for now.
Cheers, Alistair. Yeah, thank you. Yeah, thank you both as well, Mo and Al, for your very thorough run-throughs. We did have a couple of questions come in, Mo, on your section, and I think one thing that maybe we didn't touch on was currencies, and obviously there's been a lot of volatility in that part of the market recently. So I was just wondering if you could perhaps talk about the implications for that on our portfolios, and perhaps maybe on the underlying holdings as well.
Yeah, sure. So with regards to currencies, most of our exposure on the equity side, that is overseas. So we don't have that much in the UK, which obviously now with benefit of hindsight is probably been a good thing. And because it's overseas, we are therefore exposed to other currencies, mainly the US dollar. So we do monitor that, because what we do attempt, or try at least, is to ensure that we are not heavily exposed to any particular currency. So for example, the dollar, what we try to do on a sort of equity level is have about half of it exposed overseas, i.e. to the dollar, and half of it not exposed. And so over the sort of long term, clearly you'll have periods where the dollar will be strong, and periods where the dollar won't be so strong. And the net effect is that the portfolios manage those environments relatively consistently. So this year, what's happened is that, and really coming through from the end of last year, that the US dollar has been very, very strong against pretty much any currency, really, including the pound. And that's because, as I mentioned, the US Federal Reserve have been hiking interest rates quite aggressively, more so than somewhere like the UK. And so as a result, that's led to upward pressure on the dollar against the pound. What that means is that our dollar-denominated investments have become more valuable than if they were not denominated in dollars. So in aggregate, that's effectively helped to cushion some of the falls that we've seen in markets this year. So for example, our exposure to the US stock markets, if you were sitting in America, you'll be sitting on a loss of more than 20%. However, here, with the currency buffer, it's significantly less. I mean, clearly it moves around quite a lot, but it is a lot less. And so we've been helped to a degree by having some dollar exposure. But we will never be, I mean, clearly, because the dollar has been so strong, the perfect position would have been to be 100% dollars. I mean, that's never going to happen, because forecasting that is obviously very difficult, and over the long term, and that will ultimately work against us. So having sort of roughly half of it exposed to the dollar. Now, just to be clear, that's with regards to the equity positioning. With regards to the sort of non-equity bits, they tend to be not exposed to any particular currency. And the reason being is that having a sort of additional currency element can add more volatility to that those parts of the markets. And so we try to limit our currency risks in the non-equity parts. But the equity bit, we will take on some dollar risk.
Mm-hmm. Okay, thank you. And another one that came in, what you briefly mentioned was gold. Because obviously, you know, gold's had a very difficult year in an environment that people may have thought that actually it would perform quite well, you know, acting as an inflation hedge. Could you perhaps just build upon your thoughts why it hasn't performed well, and perhaps maybe your outlook for it and the role it plays in portfolios moving forward?
Yeah, sure. So, I mean, look, gold has been a very tricky place for quite a long time now. It's been way longer than a year. It did show some signs of recovering early in the year, actually, where it went on quite a sharp rally, but then it's subsequently given it all back, and we're now back to the low point that was made, I believe, at some point last year. So the main reason, and I appreciate that, you know, the broad view out there is that gold is an inflation hedge. That's not actually necessarily true, and the gold is much more sensitive to real interest rates or real yields, as it called. So the inflation adjusted yields. Now, what we've had is a situation where inflation has been has gone higher, and the Fed have been catching up. So because of that, your real yield, you know, because inflation's up here and interest rates are down here, your real yield is negative. You know, you're losing money in, let's just say, if you bought a bond or you put money in cash and you get an interest rate of 3%, 4%, whatever. Inflation's at 8, 9, 10%, and so the value of your money is being eroded. However, what's happened is that after initially going up quite significantly, inflation levels have been sort of starting to flatline in some markets, particularly the US, which is really the important market, whilst interest rates have tried to catch up. What that's meant is that your real yield has become less negative. And gold is very sensitive to that kind of environment. So when you are becoming less sensitive or even positive real yields, that has a negative impact on gold or the gold price. Now, clearly over the long term, you know, real yields move around a lot. And we, because of comments made earlier, you know, we think that there's the chance that the Fed may pause towards the end of the year or early next year, alleviating that real yield pressure on gold. So therefore, personally, I mean, I'm quite optimistic on the gold price over the next sort of 12 months or so. It's been an exceptionally difficult area in the recent past. And maybe just worth reminding actually people that we bought gold in early 2019 in Q1 when it was trading at a price of about just under $1,300. So it's still been a good investment from that point of view and that time frame. But yeah, it's definitely been more challenged recently. But personally, I'm actually more optimistic than I had been.
Okay. Yeah, always good to look on a long-term horizon, I would say.
Yeah.
Yeah. Okay. And then we just had one more come in again, because you briefly mentioned Asia and China with potential vaccine and the sort of zero COVID policies going away there. Does that present an opportunity within Asia as a region more broadly?
I think potentially yes. You know, Asia, and particularly North Asia, has really struggled really for the past 18 months or so plus. The stock markets have had a really tough time for a combination of factors, which I could talk all day about. But there's been one issue after another, and more recently, it's been a very restricted, it's been a very tough talking U.S. Federal Reserve raising interest rates and affecting markets globally, but also then China and their policies around COVID and all the other sort of regulatory issues that they're sort of brought on themselves. So having said that, yeah, look, if you've got the combination of the potential for the US Fed to pause interest rates, and you've got the potential for China to ease their COVID restrictions and maybe even bring their own mRNA vaccine through, that could create actually very favorable conditions for Asian markets. I want to be very careful in preempting that, obviously, given what's going on and the high levels of uncertainty. I don't really want to make any predictions, but yeah, look, next year, if those two things happened, I would not be surprised to see the Asian markets doing relatively well. And just to be very clear, this is more so the North Asian markets, maybe China, than other parts of the Asian markets, because the other parts actually haven't come under as much pressure, and some markets are actually up this year. So this is more about the North Asian markets that are more potentially actually more sort of internationally linked, I would say. So yeah, we are looking at it. We've got a good level, healthy level exposure already to Asia. The exposures we have actually been relatively defensive. They've actually helped us this year. They've been pretty good, fairly level. If we saw signs of those two factors coming into play, then next year perhaps we will potentially look at reevaluating our exposures and maybe adding a little bit more risk. But right now we're going to try to rein in the volatility levels for the time being.
Sure. Okay. Brilliant. Well, I'm cognizant of the time, and we don't have any more questions in, so I'm happy to end it there. But as always, if you guys have any other questions you'd like to ask us, please feel free to email either one of us, and we'll get back to you, as soon as we can. But I'll just say again, thank you, Mo, thank you, Alistair, both for your time, and thank you, guys, for joining us again.
Thank you. Thank you, Tommy.
Thanks, guys.
All right.
Thanks, everybody.
Take care, everyone.
Thanks. Take care.